It's my pleasure to introduce our keynote speaker, David Newbery from University of Cambridge. Thanks a lot, David, for accepting our invitation. It's really nice to have you. Let me tell a bit about the background of David. David is an emeritus professor at University of Cambridge. David did his PhD at University of Cambridge, and then he was a professor at Cambridge since 1988, and then emeritus professor since 2010. As I said, he's a legend. I mean, he worked a lot on electricity market design, the analysis of electricity market behaviors, on renewable support schemes. I just recently read his paper on financial CFDs. It's a very nice idea. And but David also is doing and has been doing a lot of consultancy to different stakeholders, including World Bank, Ofgem, which is Office for Gas and Electricity Markets in UK. And today, David will give a keynote on contract design in electricity markets. Very, very timely and relevant topic for Europe. Thanks, David. On practical aspects, first of all, David said that you are allowed to interrupt him. So whenever you have questions, just raise your hand. And one thing, since we are recording, and if you need this microphone. So whenever you have a question, during or after presentation, please raise your hand. I will pass the microphone to you, and then you will ask your question. Okay? Good. David, the stage is yours, please.
Thank you, Jalal, and thank you also for inviting me on the same day that two of my colleagues from Imperial College London came. I work with engineers, but I'm an economist, and as an economist, I'm skeptical about the magic of markets. So I'm going to try and teach you that you shouldn't believe everything that you hear about the perfect market delivering everything you need. And also, I want to point out that in the transition to the renewable economy, the future electricity system, I hardly need to explain this to you, looks very different from the traditional one. And the markets and the instruments that accompany those markets need to adapt. So what I want to do as an economist is try and give you the tools for understanding those challenges and how to meet them. So what I plan to do is to look at what do we want to deliver, what does a good electricity system look like, and specifically what kind of markets does it need to function efficiently. And I'll illustrate that by the British market experience. We're now on our fourth market reform. It takes a long time to get things right, but you learn as you go along. You will hear quite a lot, especially from Americans who've been wrestling with capacity markets for a long time, about the problem of missing money. I want to talk much more about missing markets and what do you do in the presence of missing markets. There are missing markets. We've actually been quite good at pricing carbon dioxide, but futures markets and risk markets are the key missing markets that need to be addressed.
May I just interrupt you for a second to turn on the microphone so people can hear you better in the room?
Do you want me to test it?
No, it's on. Yeah, now it should be fine.
Okay, I hope it's audible. Oh, good. I'm sorry I couldn't tell that you couldn't hear. You should have jumped up. Anyway, so in order to understand the importance of risk, I have to explain a little bit about the economics of risk and what the cost of risk is. And then we can move on to the central theme of how do you design contracts. This is very much an economist's idea of mechanism design. What do you want to achieve? How do you go about achieving it? So let's look at what we need to deliver. So the trilemma, I'm sure you're familiar with. The system should be reliable, sustainable, and affordable. And the first priority is reliability. The lights should stay on. And that requires adequate capacity capable of delivering in stress moments. And that, in particular, will require investment in new technologies, and not just the right kind of investment, but in the right place at the right time. And I stress place. In Britain, this is a really big issue. Maybe you're luckily connected to rich neighbours who will import your surplus power, but putting things in the right place is very important when you have a constrained transmission network. We want the plant to be operated at least cost, and we want the externalities and carbon dioxide everybody knows about. Learning externalities are less well understood, and the European Union has been rather good in setting targets to encourage people to collectively deliver those benefits of learning by doing. Now, all of this can be done in the market. It's much easier under public ownership with an efficient public ownership. If one is skeptical about the efficiency of public ownership, that's one of the motivations for moving for markets, but that requires efficient markets and efficient pricing. And if we look specifically just at the wholesale market, then just an elementary point, the price, an efficient price, should be the system marginal cost, that is the marginal cost of the most expensive plant capable of varying its output, and a scarcity element. And the way of thinking about this is if the loss of load probability is zero, the only thing means you don't have a capacity constraint, a shortage, and so it's the system marginal cost. And that happens with a probability 1 minus the loss of load probability. But if there is a loss of load, then you have to value that at the value of lost load. And you can rearrange that equation to give you an energy price and a capacity price. Now, the fiction in the European Union is that you have an energy-only market. When we privatized in Britain, we recognized the logic of this and said, well, we need an energy market for the periods of surplus capacity and a scarcity price in the periods of stress. And so we created a capacity payment system, and I'll come back to that. What we believe is that competition will work, but only if the incentives facing the agents in the system are properly aligned with what we want to achieve, and these are the characteristics that we want to achieve. This is all very much spot market. The missing markets that I'm really worried about are the futures markets that guide investment, and for that we're going to need contracts. So, just elementary magic economics. An idealized market has a complete set of futures markets for the entire period of your investment decisions, and a set of insurance or risk markets that reveal all of the information that's available to any agent in the economy. And we also assume there's no market power, there's no barrier to entry, and that typically means economies of scale are unimportant. And in that case, there are theorems in economics that says you can decentralize the efficient solution using competitive markets. Does it work? Clearly not, because we're missing these critical futures and risk markets. Electricity is unusual in that it most closely approximates the ideal of these perfect markets because we have a completely homogeneous product, all the electrons are the same. But, and we do have futures markets, but they only go out 2 or 3 liquid, relatively short term. So we have to think of what workably efficient alternatives there are to centralized electricity markets we have. And early days of liberalization, the future was thought to be fairly predictable, and certainly in Britain, under a conservative government, it wasn't thought there were very many policy risks of change of direction, and the view was you could leave it to equity markets to deal with the risk and the futures problems. You could pass the risk on, in other words, to equity holders. But things are changing, and we have to think of alternatives to this equity market as the sole instrument for handling the future and for risk. We've seen a number of strategies. The state support for low carbon generation, particularly nuclear power for carbon capture, use and storage, and for renewables. That's thought to be almost essential, particularly when they were still expensive. The problem of scarcity and capacity adequacy has been addressed with capacity markets in some cases. Other countries have enough capacity and they haven't yet had to worry about that. The problem of separating out the various elements of the industry can be resolved if you vertically integrate. And it was very noticeable that British generators very quickly bought up retail companies to be able to hedge upstream and downstream. But without that, you have to do it through contracts. And we'll look at their structure. Now, the early history, and I'll just jump forward to it's a bit farther forward. We'll go back. The early history was very much favourable to privatisation because we had adequate capacity. The technology of combined cycle gas turbines was now mature. Gas had suddenly become cheap, and that combination really favoured liberalising and privatising the UK industry. And I think people tend to forget how special those circumstances were and how hard work it is if they're missing. But coming back to how do we deal with carbon pricing, the European Union developed the emissions trading system, but as you can see from the volatility of prices, it was delivering neither plausible nor good future signals nor credible signals for making investments to deliver low carbon. And so the British government decided the only way around that was to put in place a carbon price floor, which is this upper line. And the intention at that time was to make sure that by the time we were delivering new nuclear power stations, the price of carbon would be such that the competitive nuclear power would be competitive with gas. And the way it was done was to put a tax on the forecast price of the emissions trading system to bring it up to that floor, and the floor would gradually rise. The credibility of that was rather undermined when the price was capped. The British government thought that Europeans would see this was a brilliant solution to a clearly unsatisfactory price signal for carbon, but they didn't. And so in order not to become massively uncompetitive, the carbon price was capped at that price. So when we privatised, we did it with two large coal-fired power station generating companies, 12 regional retailing companies. The nuclear power remained in public ownership for quite a few years, and the two power stations had massive market power, and as a result, they kept the price at what they thought was a satisfactory level, not too high to attract the Monopoly Commission, not too low to prejudice their profits. Now, that price immediately meant that the retailers thought, first of all, we don't like being forced to buy from only two companies. Secondly, the price is high enough to justify investing in gas turbines, but we will need to do that at arm's length with independent power producers who said, fine, we'll do it, providing it's not too risky. How do you reduce the risk? Well, you offer a 15-year contract to the retailer to buy your electricity. You sign a long-term contract with the supplier of the gas turbines to guarantee its efficiency, and then you sign a long-term gas contract to make sure you know what the price of the gas is. So you've hedged almost all the risks, and that worked very fine. I stress this because people say, well, look, the liberalisation was brilliant, there was lots of entry, the market worked. It wasn't the market that was working as such, it was the contracts that managed to reduce the risk and replace those missing futures markets. And that is one of the key lessons to draw. Now, the yellow and the red are the outputs of the two large fossil companies. The nuclear power in grey at the bottom remained in state ownership for 5 years. But you can see that the purple, the independent power producers, came in like bandits because they had a very attractive deal going. And the crucial thing is the retailers could pass through the cost of those contracts to captive retail customers because until 1998, that's 8 years after privatisation, domestic households had no choice of supplier, and the regulator approved what prices could be passed on to them, and he approved these contracts. In 1998, that captive market disappeared. Anybody can buy from anybody they liked. And long-term contracts are very risky if your customer base can disappear the moment the price falls. And so at that point, the mechanism of supporting long-term investment disappeared from the market. And we have to think of alternatives. Right, now we come on to why do we worry about risk? And the crucial thing about risk is the cost is proportional to the variance of the return. And that's a squared property. Variance is the actual minus the average squared. And that has very strong implications because the cost goes up very rapidly as the risk goes up. It's not linear. And you can expand the utility of, or the expected utility of wealth in a second order Taylor series, and you get that expression which is essentially the underlying capital asset pricing model spelled out in mathematical terms. And the cost of the risk is then proportional to the variance and the covariance, and I stress both of those terms. So if you have negative correlation of risks, that actually reduces the cost. And the clearest example of negative correlation is an upstream and a downstream company trading between themselves at a variable price, because when the price is high, the upstream does very well, the downstream doesn't. But conversely, if the price is low, the upstream is squeezed and the downstream does very well. So they're completely complementary, negatively correlated risks, perfect situation for reducing risk by signing a contract. But what is less fully appreciated is if you spread the risk over n agents, and it's uncorrelated, so we've got the pure cost of risk, then you can do the sums and say, well, because it's a squared phenomenon, you actually reduce the cost of risk in proportion to the extent to which you spread it. So when people say, as our illiterate government tends to say, the risk should be borne by those capable of managing it, meaning typically the developer, that neglects the fact that the cheapest way of bearing that risk is to spread it over the entire population, which massively reduces the cost. The cost of small risks is negligible. The cost of high risks is absolutely enormous because it's a squared function. So that's the central message of the theory of risk. Right, so what do? We need to deal with contracts for a variety of risks, and correlated and uncorrelated, those matter. We have to worry about price risk in the market and volume risk, particularly for renewable energy. If you have dispatchable plant, fossil plant, gas turbines, it's mostly price risk, and for that, a contract for difference, and I'll explain that, works very well. If we're worrying about persuading people to invest in flexible plant for future delivery, then a capacity contract may be adequate. Different kinds of capacity contracts do different kinds of jobs. But when we come on to variable renewables like wind and solar PV, you have price and volume risk. And you need a suitable short-term contract and a long-term investable contract. And I'll talk about the yardstick contract for difference. If I have time, I probably won't, I'll talk about the problem of how you finance nuclear power in a liberalised market. So, what we need to balance is efficient incentives on the developer to actually produce at least cost and get the thing up and running efficiently, and risk sharing, spreading the risk as widely as possible. So if we look at contracts for difference, then, as I've said, retailers and generators have complementary risks. They need to contract to reduce the cost, and the standard contract of I've called it a fossil CFD to stress that it's one where you can choose how much to produce. You set a strike price, and you have a spot price in the wholesale day-ahead or spot market, and a marginal cost of production C. So you specify in advance how many megawatts of capacity you're going to cover and the length of time, whether it's for base load for a 6 months period or whatever. And then the contract pays the strike price minus the spot price. So if the price is higher than the spot price, the generator gets the spot price and the retailer gets the difference between the two. So it's effectively buying at the spot price, and conversely if the price is below the strike price. But the big attraction of this, and the point to stress, is that if the price is above the variable cost, it's worth honouring the contract and delivering to meet the contract. But if the cost is above the price, if the price is too low, then it's cheaper to buy in the market to meet the contract and avoid having to produce at a loss. So the crucial thing is that it's a purely financial overlay on the actual physical market, and it's a purely financial hedge. And it does not distort the decision about when you produce. And that is the characteristic that does not apply in most contracts for difference for renewable electricity. And that's one of the problems we want to address. So I come back to credibility. One of the problems, of course, was that we reneged on the promise to keep raising the carbon price, so we had to think for an entirely different way of financing nuclear power. But the price was high enough to massively eliminate coal from the generation mix. Now, this goes back to 1970, and you can see many exciting things. We had a miners' strike when we burnt oil instead of coal. We privatized the industry in 1990 and set up a pool for trading. We had a new electricity trading arrangements where we abolished that and had the energy-only market because that seemed to be flavor of the day. And then when that wasn't working very well, we had the electricity market reform in 2013, a new Energy Act, and we're now in the middle of reforming the electricity trading arrangements again. But the only thing I want to really press now is you can see at privatization the dash for gas. We've moved away from coal, even though with adequate capacity to meet all the demands. More recently, the dramatic move into renewables in green and brown, and the disappearance of coal from the system. It's effectively hardly producing anything at all now. And that was driven partly by the high carbon price and partly by the various emissions directives that made it increasingly costly to refurbish power plants. So what that meant is as the old coal plants disappear, reliability, adequate capacity became a problem. And in the old days, all of the flexibility came from our inefficient old coal-fired power plants, which could be kept for running in the winter periods and when there was high demand and all of the capacity was called upon. But the coal was going off the system for all sorts of reasons, mainly the carbon price. The gas in this period was becoming very expensive, and most of the investors were saying, well, the old days of having contract coverage for long-term power producers, that's gone. The price of gas is now high. It doesn't look very attractive. The governments are committed to renewable energy. Why should we invest in the capacity we need for flexible meeting of demand? And increasingly, people were aware that policies were in a state of flux. Every year somebody would say, well, we should increase the renewables target, or we should move forward the date at which the system should be decarbonised, or we should or should not have nuclear power, or we should decommission power plants. The policy environment was becoming increasingly unstable and very difficult to hedge. And at that point, it was decided, in Britain at least, with this confluence of circumstances, we needed capacity markets. Now, the American experience of capacity markets was very much that most American electricity markets have a price cap at an absurdly low level of about $1,000. Texas was unusual in not having one. The big freeze of a year or so ago meant that the prices actually went up to over $11,000. a megawatt hour, and some consumers have suddenly discovered that they were bankrupt. But anyway, for that sort of reason, most of the regulators put in low prices, and at those low prices, you couldn't justify any investments. So the solution was, well, you need a capacity market. There's another solution, which is to say, and I'll come on to this, you could put in place a contract to hedge against those high prices, and that in many ways is a much more attractive solution. But the missing markets problem was underappreciated. Futures markets I've already stressed. The carbon price, well, it's sort of getting there. The British solution was you needed a predictable carbon price, difficult to make credible, but it did have some impact. And you needed hedges against regulatory risk, changes in the market circumstances. And you also need a full set of ancillary markets, and I'm sure we're all going to delve into that. But I think this has been relatively slow in being appreciated because most ancillary services were automatically supplied by the kind of fossil generation, flexible fossil generation on the system. You didn't have to pay extra for inertia. They had reasonable ramp rates given the size of the systems. But now none of that can be taken for granted, and you have to think carefully about paying for those. And if you ignore those markets, if you don't pay for the things that you need, then there's obviously a missing money problem, even if you get round the price cap problem. So we had a capacity auction. The government predicted that the net cost of new entry, the net cone, was about £50 a kilowatt per year, £50,000 a megawatt per year. And this is the first capacity auction, and I've put it on here because unusually they published the entire price ladder of bids. Now they only publish the ones that weren't accepted, and they realised that otherwise you can coordinate on what your competitors are doing. But this cleared at a price of £20 a kilowatt per year, and in exchange for a capacity certificate, you had to be available to deliver within 4 hours of an announced stress period, and if you didn't, there was a fairly high penalty. So you're being paid to be available, to be there when the system is stressed. And that was the function of the capacity auction. The single electricity market of the island of Ireland went down a different route, and I would have argued a purer contractual approach. It's also, I think, common in Chile and Australia, but you have essentially a one-sided contract for difference. You set a high strike price. It's higher than the most expensive plant on the system, so it never discourages people from not generating. As I said, a contract for difference, a normal one, two-sided one, means that you make a decision on the basis of your cost and the market price. So we want to make sure the market price is high enough that nobody who could be available is discouraged from delivering. So that's a high price. And then if you're willing to accept a reliability option, there's an auction that determines how much you would be willing to pay for never selling above the strike price. And the incentive to be available is if you're not available, you have to replace your generation by buying in the market. And the attraction of this is the spot market is allowed to go to as high as is necessary to clear the market. And indeed, in most markets, Texas and Ireland, the regulator puts a price floor proportional to the value of the loss of load probability to make sure that the spot price is high enough to signal scarcity. And in the case of the island of Ireland, the crucial thing is you want to trade with Britain at the value of electricity, not an artificially constrained low price. So this allows you to trade with the rest of the world at efficient prices while hedging your consumers against high prices and guaranteeing a revenue stream in this auction price for the investors to make a decision. You get a 10-year contract, you're guaranteed a payment per megawatt of capacity, and on the basis of that you can finance your investment. And since it's an auction, you decide how much you need to be reassured. So let's move on to the other side of the story, what do we do with the future of the transition to net zero? And in Britain, the government has said, well, we want net zero for the electricity industry by 2035, which is pretty close. And to do that will require massive investment because the cost of renewables is all capital, hardly any running cost, and it's all up front. So you want to reduce the cost of borrowing for that to the lowest feasible level. And that means reducing the risk, because the higher the risk, the more you have to persuade the equity investors to part with their money. And the way of lowering the cost is to therefore reduce the risk by a contract that therefore allows you to borrow mostly for debt finance, which is cheap. And in the case of renewable output, obviously there's future price risk, there's cannibalization risk, there's policy risk. You don't know what the future price of gas is. It might be high. If there's a war, it might be incredibly low. If there's a glut. The output in the short run, but not in the long run, is unpredictable. So we want to look and see, well, what kind of contracts deal with these various kinds of risks and how can we adjust them? I've already discussed the problem of delivering flexible gas supply with capacity markets. Interestingly, the capacity markets were set up expecting mostly gas generation. Increasingly, we have batteries on the system because they provide the fast response that you need in stress periods. And that is actually the way the market needs the capacity mix to change. So what we now have to think of is not just markets, but hybrid markets. So you have competition for the market in an auction for a long-term contract. That's the contract part. And then when you have the contract and you have to operate in the spot market, you have competition in the market to set the price. And it's this hybrid nature of a contract to cover the investment risk and to incentivize you to behave competitively in the spot market that are the driving forces that should guide the design of the contracts that you will need. So this is just showing one rather optimistic view of a national grid in the future energy scenarios. This is the one they published for 2030. Leading the way means really ambitious. And you can see that the capacity is the big wide bars, and the thin bars are the outputs that are being produced. And you can see that the fossil generation in black, we still have quite a lot on the system, but it hardly operates at all. It's there really as backup. And the blue is the large amount of offshore wind that we seem to be moderately on course to deliver. So a huge amount, a trebling of capacity needed, and therefore a huge investment demand. And you can see that trebling compared to where it had been in 2020. So let's have a look at the risks facing the participants in this market. Now this is an exciting period back in 2010. And these prices are daily prices for exactly the same product, which is delivery for the calendar year 2010. But you can trade it all the way up to the delivery date almost. And you can see that the price of electricity and the price of gas plus the carbon price that you need to burn the gas and the coal price, so these are clean spreads that you have, all move in sympathy. So if you're a fossil generator, or you're gas-fired or coal-fired, essentially you're hedged if you're hedged in the fuel market, because the price of electricity is linked to the price of the fuel. So that massively reduced the risk for fossil generators. But if you're a non-fossil generator and you look at that volatility in the electricity price, you're not hedged against that. So that's an aspect of the problem that used not to be a big problem and is increasingly a problem. Whoops, that doesn't look good. Oh, there we are. Wait, yes. So the renewables faced a lack of a natural hedge in the fossil fuel markets, and they needed a long-term contract to be investable. And there are a variety of models that way back in the dark ages of 2010 and before were on offer. The continental approach was very much a feed-in tariff, which pays a fixed price on the metered output. You don't have to worry about finding somebody to buy it, you just sell it to the system operator. The British and to some extent various other countries went for a premium feed-in tariff where you get a premium on the wholesale price. And the argument was you do want to make the producers responsive to the wholesale price. And in Britain we had renewable obligation certificates or green certificates in some countries. And then the evolution and now the EU preferred model is for a contract for difference with feed-in tariffs where you set a strike price and then you pay back if the actual price is above the strike price, like an ordinary contract for difference. But it's a feed-in tariff in the sense that it's on metered output, not on a fixed amount. And that has obvious problems. And then what I've called the yardstick contract for difference says, well, we want to restore the financial hedge, but we want to provide the incentives for looking at the spot price. So we make the actual amount covered depend on the amount you would expect that wind turbine or PV panel to produce, and you can either do it on a forecast or on the local area output of comparable power generators. That's a matter of detail. I would leave it to the developer to choose how he sets the yardstick. And then the other element of the contract is, how long is it for? Now, simple-minded folks say, well, the banks want it for 10 years or 15 years, 10 years or 15 years. That's really the bad idea. So I would suggest you want it on full operating hours. I would suggest, say, 40,000 megawatt hours per megawatt of installed capacity. And that pays off the cost of the plant. And the crucial thing is it does what you want, which allows you to debt finance it, but it doesn't over-reward you because you happen to choose a windy place. And the last part of the element of the design is how do you set the strike price? Do you ask a bureaucrat or do you ask the market? So let's have a look at what we discovered. So this was the green certificate renewal obligations. So you can see the ROC price is fairly stable because you can trade those, but the wholesale price is very unstable, so the ROC price plus the wholesale price, which is what you get for your wind farm, is pretty unstable. So you go to the bank and you say, when the price is high, lend me money, look at this incredible investment. And the bank says, but 6 months ago the price was low and it might be low in the future, so no. In other words, all of the risk is transferred to the developer and consequently not much debt finance. And so therefore a rather expensive way of financing it. In fact, I did a calculation and showed that the cost of capital is 3 percentage points, real percentage points higher, which over the capital base is billions of pounds a year in extra cost because of this bad design. So how do we set the price? Well, in the good old days, bureaucrats would go down to the market and say, how much would you like to be paid for your wind turbine? And they said, oh, very expensive. So the price was set very high, 220 euros a megawatt hour for the early offshore wind farms, and about 150 euros a megawatt hour for the early onshore wind farms. And of course, they did very well indeed. Then we moved to auctions, and as you can see, the price comes down dramatically. These are all in constant prices. So you can see that the offshore price essentially went to 1/3 of what it had been, and wind farms similarly. So auctions set prices much better than bureaucrats. I think we understand that. Okay, so that's part of the story, but the other part is you have to tell people where to locate. And in Britain, all the wind is up in the top left-hand corner, and all the people down in the bottom right-hand corner, and it's a long way between the two. So if you just say go where it's windy, you have a serious problem. Now, fortunately, we have a long tradition of setting transmission network use of system charges to reflect the cost of moving power from distant places to where the customer loads are. And the spread over the range, the number 1 is northwest Scotland, and number 24, I think, is somewhere in London. And that spread is about £43 a kilowatt per year, which was twice what we paid for a capacity certificate in the first auction. So this is a significant incentive to locate where you should. Now, the problem is that these network use of system charges are based on the fiction that you can incrementally and instantaneously increase the size of each wire to take a little bit more current. That's one problem. The other problem is you don't want to frighten the horses, so you keep the prices pretty stable from year to year, and you just adjust them a little bit. So at any moment, the prices are completely wrong or only coincidentally correct. And they don't give a forward signal. They give a, as it were, a slowly adapting to the past signal. So they're not very good, but let me tell you, they're a hell of a lot better than most of the continental price signals for generation location. And how do you solve this problem? Well, again, it's a contract design. You say, anybody who's already built their power station, these signals are to guide location. They're not going to move. So you give them a grandfathered contract so that they don't get upset and take you to court for changing it unreasonably and unjustifiably. But you're completely free to offer at each point on the system an appropriate tariff to guide the new investment. And you can change that each year. And there, as far as I can see, is no contractual or regulatory or parliamentary objections to offering those contracts each year. Because in most countries, and GB is no exception, the money is essentially collected from consumers, not from the generation. The average over the system is designed not to be more than, I think it's 2.5 megawatts, 2.5 euros per megawatt hour. And that's so that trade between countries is on an even basis. Okay, so what does that mean? Well, the way we have a contract for difference with a fixed time horizon is if the auction clears at a capacity factor of 25%, then anybody who is in an area with higher capacity factors, and otherwise known as Scotland, and these are actual wind farms, mostly in Scotland, showing that they all get very large inframarginal rents. The little dots are what they would have got if there hadn't been the transmission charge to collect some of that rent to extract from the distant wind farms, but it's not doing a very good job, and there's a lot of inframarginal rent. So if instead we think carefully, what is it we're trying to achieve? We want to get people to be in the right place, we want them to operate when the market price signals are correct, and we don't want to pay them more than is necessary, then you start thinking of designing a contract with those characteristics. So it should hedge the long-term risks, sure. It should give you the right location signals. It should give you the right short-run response. And it should squeeze out that inframarginal rent I've just shown you. And essentially what we're doing is we're paying for capacity because that's where all the cost is, but we want people to have an incentive to then operate and produce wind farms and so on that actually operate. So what we want to do is to make the payment independent of the market price and pay the least amount we can. So we use the transmission contracts to guide this location. Very difficult to do it in a uniform price auction otherwise, because we want to preserve as much liquidity in the auction for setting the strike price. So all the location signals are done through the grid charges. And then we have an efficient transmission charge, and that gives you certainty about how much you're going to pay to be on the system. And then we want efficient dispatch, which is independent of output. And as I've said, we do that by using a forecast capacity factor and paying the difference between this spot price and whatever is the regional price, if you go down a zonal pricing model or a nodal pricing model. And in that case, limiting the number of operating hours gives the same payment for each wind farm regardless of the capacity factor. It gives them it either faster or slower. And since, roughly speaking, it costs the same no matter where you put the wind farm, we extract all of the rent. And the auction price will determine how much rent is needed to actually get the investment. Oops. So, that's where I was. How are we doing for time? Maybe time for, I don't know how much time we should be for Q&A, or shall I keep going and talk about the renewable?
Maybe you can have a short break to have maybe one or two questions.
Yes, so why don't I'll jump to the conclusions and then we can take questions from the audience. So what I'm saying is we really have to worry about the cost of risk and how to handle it. The transition throws up new risks that we have to address. The old models of contracts for difference don't necessarily work. And we want to learn the lessons from those. They were purely financial hedges, and they leave the market in the spot market to give the right decisions. And that is not the current model for renewable contracts for difference. And we have to, as I say, specifically think that these renewables don't have the fuel price hedge that the fossil generators have. Having said that, the fossil generators do face risks where a renewable obligation, a reliability option or a capacity auction is the natural way of making sure you get the right stuff on the system. And when we have contracts to deal with the missing futures markets, we have a hybrid market because we have competition for those contracts, and then the market is left to provide competition between all of those generators available to set the price. Good. So we now have some few minutes at least to take questions.
Yeah, we have 10 minutes. Thank you so much, David. I will hand in the microphone, so whenever you have questions, please introduce yourself and affiliation. Adam.
Thank you, Professor Newbery. It's Adam. I'm from a PhD student at Imperial College London. So my question is that if we go forward this way and in 10, 15 years, 80% of the capacity in the system will be actually subjected to these different types of long-term contracts, mainly VRE capacity, how do we make sure that the shorter markets, sports markets, are still relevant, especially that we want to actually subject more and more consumers to the varying prices, right? We want to have them more responsive. So how we actually do it?
Well, that's just the question I wanted, because that's what I've stressed. We have a hybrid market. So the contracts are dealing with the finance problem, but the spot market is going to set the spot price. Now, if you, as I think is reasonable to predict, we have a lot of renewables, certainly within any transmission constrained zone, then the price will fall to the avoidable cost of the renewables, which for wind isn't zero, but for PV is. And that's exactly what you want to happen, because where the batteries are going to make their profits and where the hydrolyzers are going to buy their electricity to produce hydrogen, and where the consumers are going to charge up their electric vehicles and heat up their hot water, you want low prices in the spot market. But you need the hedges to make sure that people don't lay awake at night wondering what the hell is going to happen tomorrow. And I've suggested the contract for difference with a natural hedge on the output for renewables is the long-term solution to that. The capacity market or a reliability option deals with the problem of the flexible capacity on the system, and the consumers are going to be protected by essentially having various kinds of contracts. And I haven't spent much time on the consumer side, but that's equally important. And one obvious solution is you have the time of use meter, but the default is you never pay more than you would have done under some contractual arrangement. So you have all the incentives to respond to the spot price without having to lie awake wondering whether you're going to be bankrupted.
Very good. Yep.
Thank you. My name's Liang Du. I'm an assistant professor of Temple University in Philadelphia, in the U.S. It's glad to talk to one of the legends. So I have a couple quick questions. Can you please comment on, you have been talking about the capacity markets and all the long-term contracts, and say, for example, in one of the plots you showed that the current national grid in terms of demand capacity is around 100 gigawatt in 2020, and then in 2030, the long term, they go very ambitious on, say, for example, 200 gigawatts. So that raises a concern of overgeneration, right? That's one of the problems nowadays we are experiencing. We have not in the East Coast, but in the West Coast, in Texas, we have a lot of such resources, so that in a good day, not like this day, in a good day, sunny day, like the whole RTO may have like a couple of hours of net zero demand from the RTO itself, and then we have overgeneration. We even have negative prices. We have all kinds of problems that I think you mentioned one of the solutions is actually the flexible services, which we don't really have nowadays. So can you please comment on what's your vision on, what other moving pieces that's going to go along with all this renewables, decarbonized, power markets, power systems, along with the design of contract for the capacity market? Thank you.
Well, thank you for that. There's a whole other lecture I could give on the problem of overproduction. So you're quite right. So if you think, well, I've been looking a lot at Queensland, where wind and sun are really strong. So the peak to average output is between 3 and 4 to 1. Here, for solar PV, maybe 11 to 1. Anyway, the point is that if you want to achieve a certain average amount of renewables, the peak is going to be many times that average demand. And so you clearly have massive surplus capacity. And it's worse, because the marginal curtailment rate, the surplus spilled wind or sun, is about 3 to 4 times the average. So if you get up to an average curtailment rate of, say, 15%, which in some of the markets I've been looking at is, roughly speaking, where they expect to be in a couple of years' time, the marginal curtailment is 50%. Another way of looking at it is it's twice as much per unit of capacity to deliver the renewable power from the last megawatt. So you then start asking serious questions about how far do you want to push renewables into this system before the cost becomes higher than decarbonizing other sectors in the economy. Clearly, you're going to have to curtail and spill, even when you've got, you would never have enough batteries and export capacity, maybe except in Denmark, to push the problem onto somebody else. But the work I've been doing anyway says there's a lot of correlation across markets, so that when you have a lot of wind in Denmark, they probably have a lot of wind in North Germany as well, and only because they're silly enough not to price differently in the north and the south, you can get away with it, but at some point it's all going to break down in tears. So yes, there are all sorts of interesting challenges that the rest of the week I'm sure will address.
Fantastic. I'll start with Rodrigo and then I'll come to you. Well, if you want. Yeah, I'm here now.
So, David, thank you very much for your presentation. It was very inspiring. I fully agree that the future should be more based on these long-term contracts, which actually makes a lot of sense to push for the investment we need. But let's be honest in the sense that we're really moving risks from agents to consumers, right? So the risk doesn't disappear. So you're taking the risks, which is actually being taken by producers, and now you just taking from them and put it into consumers. So every time you fix, for example, TNUs for 20 years, any mismatch between TNUs and the actual cost of transmission is going to be borne by consumers. So what is your view in terms of what is the right balance between the risk allocation between these producers and consumers?
Okay, for TNUoS it's very simple because it's a regulated asset and the total amount of revenue is determined by the asset base and the cost of capital. So anything you don't collect from generators, you collect from load. The charges for load for domestic households are relatively small. They're not insignificant, but compared to their annual income and consumption, they're modest. And the point I wanted to stress with the cost of risk is the wider you spread it, the less is the total cost of risk, not the individual cost, but the total cost. So passing it on to consumers is exactly what you want to do, spreading it as widely as possible. Now, of course, equity considerations may suggest that you should put more of it on the rich and less on the poor, and there are ways of doing with that. But the idea of passing those risks that are inescapable, and I stress inescapable because if we're committed to decarbonising and the wind being what it is, they are inescapable, you pass them on to the widest possible base, otherwise known as consumers, you and me.
Hi, this is Daniel from Saudi Arabia, from KAUST. We have a very different power system that relies mostly on government funds, but as you mentioned, including renewables, you need to consider the reduction of risk in these technologies. And I wonder, for example, if one company wants to invest in renewables and goes for funding, how do the public fund or the bank define which is the risk associated with that contract, for example? Not talking about the design of the contract with the allocation of the market, but when they look for the money, I wonder if, for example, they use a typical meteorological year to define which is the production, or what kind of variables they need by then to define, for example, the interest rate, because that then is reflected on the price that they will offer in the capacity market, for example.
Let me see if I've understood. There are two kinds of problems governments face. One of them is for emerging technologies, hydrogen, carbon capture and storage, whatever. And the other is for mature technologies like onshore and increasingly offshore wind. With mature technologies, essentially you say the development risk, in other words, working out whether when you build the wind turbine it will operate, and the forecast of the wind, given that you have all these climate models and error satellite data to forecast wind in your location, you place the risk of figuring out whether this is a good place and a good design for your wind turbine on the developer. And then the risks of what the value of that output is, we hedge and pass on to consumers. When it comes to immature technologies, that's much more problematic, and typically you know perfectly well that the first of a kind is going to be very much more expensive, and what you want to do is to have an innovation competition to get the best ideas competing. You fund them and you make sure you learn as much from it as possible so that next time round you can design a better version of whatever it is. I don't know if that was quite what you had in mind.
Yes, that answers part of my question. I wonder, for example, if for these models that are used for defining the financing of the projects, if, for example, it's considered the average production that is expected, or if you consider, I don't know, the P30 or a percentage of the total capacity that you expect to have.
Right. I view this as very important graph. So the one on the right shows the real rate of interest in the US and the UK over a long period of time. And what you see is a pretty persistent downward trend, which has flattened out in the last few years. There's a lot of fuss about what's been happening to the nominal rate of interest, but the real rate of interest, when you correct for inflation, actually hasn't risen very much and is now pretty low. So the cost of borrowing, and this is driven by demographics and excess savings in China and all sorts of interesting things, but a trend is a trend until it bends, and it may be bending now, but it's bending at a very low level. So the cost of risk-free debt is really low. And the consequences of that, this is for financing nuclear power stations, but the same principle applies whenever the money is up front and the running costs are low, is that if you double the cost of capital, you essentially double the cost of delivering the power. And so the benefits of lowering the cost of capital by appropriate contract design is huge. And that's the message I wanted to get across.
I'd like to take the privilege of being moderator and ask the last question. So here we have 60 amazing, talented researchers. Most of them, they are writing their PhD work. So if you suggest us 1, 2, or 3 topics that you think they are really important, and by working on that we can make impact on green transition, what topics related to your talk you will pick that you think they are super important to work on? And if you have any advice to us, to researchers, to PhD students, what to do in their career, that would be awesome.
Okay, let me give you a generic problem. And it may be less of a problem in some countries, but it certainly is a problem in mine. If you think you have to change the market design, then you have to think very carefully about how you persuade people who are going to be adversely affected about it not to oppose it tooth and nail. It is a principle in public finance, public economics, that says the efficiency gains that you make from a change may be worth having, but the redistributional consequences may be 5 or 10 times as large. So you make a 5% improvement in efficiency, but you may make a 25% increase and decrease in the revenue of some agents. So the crucial thing that anybody who's giving policy advice has to figure out is what kind of transition contracts will make participants who have already made their investment decisions under some expectation of the future, keep them whole without giving them an arm and a leg, and allow, therefore, for them not to object to these transitions that you would like to implement. So that's, if you like, the economist in me telling you that if you as engineers want to get an idea into the market, you have to think very carefully about how you deal with the fact that almost everybody in the market has already made their investment decision, and they're going to complain if they're going to be made much worse off. And I say that because we're thinking, and every country should think about nodal pricing, which is critically important when the transmission system was designed for a previous and completely different structure of generation. Nodal pricing means huge redistributions of potential income, and transition contracts are very important. But having said that, there are other things like how do you design a contract for hydrogen, for a battery, for pump storage. Any investment decision, and all of the investment decisions now are expensive, how do you reduce the risk while making sure that they have an incentive to do the right thing and operate the thing properly? So that's the message that an economist can give you.
Thanks a lot, David. Let's thank David one more time.